Well, folks, the time has come for us to talk about 10 stocks that are buys now, and these stocks are all down at least 50% from 52-week highs. Yes, 50% plus from 52-week highs. I like to do these videos every once in a while, but it's very rare I get to do one of these videos. I think the last time we got to do one of these was in the 2020 stock market crash. So very rare I can find 10 stocks or more than 10 stocks in the market that are down over 50% that I feel like are buys. Usually in the market, I feel like there's maybe 3 stocks, 4 stocks, 5 stocks to buy at a particular time. If stocks are a rip-off at a particular time, then I only feel like there's maybe 1 or 2 stocks to buy. And there's been other times when I've gone, several weeks or even a month without buying any stocks because there aren't any good deals. Well, this is not that type of market right now. Matter of fact, I feel like there are great deals all over the place, okay? I mean, like a lot of good deals. If you haven't been keeping track at home, more than 1/3 of NASDAQ stocks are now down 50% or more, so over 33% of these stocks out there. We have over 2/3 of the stocks in the NASDAQ are in a bear market right now, and the NASDAQ started out this year horrible. We're already down almost 5% year to date when it comes to NASDAQ, and there's kind of 2 ways of thinking about this. Some folks look at this and they say, oh, stocks are going down, that is bad, stay away from stocks, right? That's not the way I think, but that's the way some folks think out there. The other group of us say, okay, stocks are a deal, they're down huge, that's the time to buy, right? Last time I want to buy is when stocks are at record prices, all at 52-week highs. I think that puts you at a big risk in the market. However, when stocks get really, really cheap, and especially where you think these stocks are going over the coming years based upon their revenue, their net income, those sorts of things, that's when pricing gets very, very attractive. Just because a stock is down a ton does not mean it's a great buy. At the same time, just because a stock is down a ton does not mean the stock is doomed or something like that. Because a lot of times stocks are very mispriced in the short term, and you have to understand that, okay? So I hope you guys enjoy this video. Hope you get a lot of value out of it. Let me know if you own any of these 10 stocks we discussed in today's video. If you think these are stocks to buy, just stocks to watch, I would love to hear from you guys in the comment section. As always, and also make sure you subscribe to the channel. All we do is talk the stock market on this channel all the time, and stocks to buy, those sorts of things. Alrighty, guys, the first stock up of this bunch of stocks is TDOC stock, TDOC. TDOC is the first stock up here, so this one is obviously massively off its 52-week high, down way more than 50% nonetheless. It's 1 year for TDOC down about 64.6%. 1 year, look at the 3-month. What you're going to find in common with many of these stocks is the 3-month, basically track record for these stocks is awful. And I mean absolutely awful for almost every single one of these stocks we're going to look at. The 3-month is horrible. Yeah, a 41% downward move in 3 months is beyond vicious. This isn't a normal time in the stock market, I can tell you that. It's not normal that you find a ton of stocks down 20, 30, 40+% in a 3-month span. But in this video here today, we're going to get in a whole bunch of them, okay? Now, when it comes to TDOC, it's been trading right around its 52-week low very recently here. 76 is its 52-week low. 79 is where it's at today. $12 billion market cap. This is a telehealth company, if you didn't know. They're set up to be the #1 player in telehealth, whether it's physical health or mental health. They're set up to be the #1 player in the United States over the next decade or so. So they're in a phenomenal position. A decent amount short in this stock, but not a crazy number. We're going to see some pretty crazy shorted stocks in this video. About 14% of the float is shorted on this particular stock. 423 is the revenue per employee as of right now. That number should go up quite dramatically. When it comes to TDOC, there's a company that's expected to be much closer to profitability in 22 than they've ever been. So they lost or at least in recent times, they lost $5 plus last year. So yeah, that's a lot of money to lose in the bottom line. This year, they're expected to lose a little over $3. Next year, they're expected to lose about $1.65. So when this business does get profitable, in my opinion, based upon all the study I've put into this business, it's going to be an extremely profitable business model. It's going to be a thing of beauty. However, they've got to get to that point of profitability. I think 23 is a year where they're going to get close to profitability. I think they're still going to lose money in 23, but they're going to get close. I think 24 is likely that first year that they can start pushing a little bit of profitability in 24. So you kind of got to get from here to there. And right now in this market, everybody's pushed anything that's losing money. Just about any stock in the entire stock market that loses money has just been pushed down to the ground right now. That's not going to last. And I've been doing this for 14 years and I've just seen consistently that doesn't last. At the end of the day, you go through these time periods where growth stocks and anything that's money losing just gets pushed down. That does not last. At the end of the day, what do people really want to hold? They want to hold the companies that have the big growth rates. And TDOC has that type of growth rate. And when it comes to TDOC, it's 27% expected revenue growth in 22. This is one of those business models that's beautiful from the standpoint of you never have to worry about this company not growing over the next decade. They're just going to continue to grow and grow and grow. You run into a lot of trouble with a stock if you buy an unprofitable company at an all-time high or something like that. You can run yourself into trouble. So if you're buying TDOC at 300, you were setting yourself up for a bad situation, right? Or even 200, 250, something like that. Now at a 52-week low at $70-something, that's a whole different situation. Down 64% over the 1 year, down 40-something% on the 3 month. It's a whole different situation. And so you're setting yourself up for, I think a pretty good stock over the coming years when it comes to stock. Doesn't mean over the short term it can't go down more, but that's just a chance to lower cost basis if it does go down anymore at the end of the day. So yeah, when I look at TDOC, it's a phenomenal opportunity for the next several years, and that's why it's the first stock of these 10 stocks. Stock number 2 is Square stock, SQ. Square. Wow. Okay. So first off, this one's down over 50% plus from its 52-week high, as all these stocks are. Oh my gosh. Look at the 3-month for SQ, down 46.47%. Oh my gosh. Okay. Square, I think everybody knows Square for their traditional business, which is essentially running transactions. If you're a business, a lot of small businesses like to use Square. It could be restaurants, it could be retailers, even back when I had my real estate marketing company in 2016, 2017, I used to run clients' transactions through Square, like a little thing on my iPad or iPhone or whatever. You could swipe people's cards if you needed to swipe a card, or you could just enter in the card details. It was pretty cool. But in terms of Square, this stock's just been devastated. This market cap, by the way, is off. I think Square's market cap's technically a little lower than that right now, but nonetheless, that's somewhere around there roughly right now. About 10.8% float as a float is shorted on the stock, so not a crazy number at all. And when it comes to Square, there's a company, let's keep this in mind, they own the number 1 most popular financial app in the entire United States of America. Now, that's huge, okay? Like we can never understate that when it comes to Square stock. When you own the number 1 most popular financial related app in the entire United States of America, that's a huge deal. This is something that 10 years ago no one would even pay attention to. But I can tell you nowadays, the fact that everybody has a smartphone and everybody is use their smartphone for basically everything. When you own the number 1 most popular financial app, you're going to be able to make a lot of money off that thing long term. There's no dang doubt about it. Now, PayPal, by the way, which is another stock, we can feature PayPal in this video because it's not down technically 50%. Otherwise, I would have put PayPal on it. PayPal owns number 2 and number 3, so do keep that in mind if you're interested in PayPal. But yeah, nonetheless, this is a company with Jack Dorsey that's very, very focused on blockchain technology and crypto and all those sorts of things as far as actual use cases, which I think is big as well. All right. Now, when it comes to Square, here's what scares people. This number right here, the growth expected to go down massively from 85% to 6%. This is something that scares people. I think 22 is going to be a fluke year for them in terms of their revenue growth. I think at 23 and after, they're going to be back to double-digit plus revenue growth. And don't be surprised if they end up putting up a double-digit number in 22 as well. But in my opinion, they're going to be back to double-digit plus growth as far as their revenue line item goes for 23 and beyond. And this is another one of those businesses that you don't have to worry about as far as them growing. They're just going to continue to grow and grow and grow. I think 22 is just a fluke year based upon the study I've done in this business. Now, in terms of EPS, here's a very important, okay? 84 cents is all they did last year. $1.69 this year expected. $1.85 in 22. So they have they have profitability that is continuing to go up for this company. So this isn't like, oh, this is a money losing company or something like that. This is a money maker, and their profitability will increase exponentially over the coming year. So Square stock, definitely one of those stocks that's just been devastated. And I look at this one as a 3-5 year type hold as being a great opportunity, as with all these stocks in this list. Okay, let's get into number 3 of these 10 stocks. That is a stock to buy now. Corsair Gaming, CRSR. So Corsair, they own the Corsair products. So if you know anything about gaming, you know Corsair. You know they make quality products that a lot of people respect. They also own the Elgato brand, which is becoming huge in streaming hardware, cameras, microphones, all those sorts of things, stream decks, stuff like that. They also own several other brands that are in the gaming space as well. Right around its 52-week low. 52-week low is 1974. It's at 2075 here today. Market cap of under $2 billion on this one. PE ratio of about 16. Forward PE even under that. So it's not like this is some crazy valuation company. This is one of the few on this list that is a moneymaker and also doesn't have a high PE on it at all. Okay. As far as the float, 28.77% of the float is shorted for the stock. So this is a heavily shorted stock, which sets it up for being a potential squeeze candidate. Doesn't mean it's going to squeeze, but when you start talking about 20+% of your entire float is shorted, you're a squeeze candidate at that point in time. Okay. Obviously, the stock's down way more than 50% from its 52-week high. As far as the 1 year, 45%, 3 month, it's gotten devastated, down 16% plus on good old Corsair Gaming. Now, when it comes to Corsair, one is this is a business model that is not some new age business model that's like no one's ever thought of or something like that before. This is a business that's been around for decades. Andy Paul's been running this company at a phenomenal level. He does a great job of running it. The gaming sector can go through it's kind of a roller coaster ride. 1 minute gaming's going crazy and you got some big new game that was launched. Next minute you got nothing out there. So with Corsair's business model, this is becoming much more of a diversified business model, especially when it comes to their streaming products, hardware, and things like that. And also they own brands like Scuff Gaming, which basically is like custom controllers for PlayStation, Xbox. If you're super into gaming, you know about stuff like that. If you're not, you're like, what the heck? There's custom controllers? Yes, it's actually a pretty decent business for Corsair at the end of the day. But profitability is expected to go up for this company over the next year to $1.59 from $1.35 in 21. A lot of folks jumped out of this stock in 21. The reason being is profitability went down and revenue growth rate slowed way down. So a lot of folks just flooded out of this stock. But at the end of the day, is this a great business model for the long term over the next 5 years? Let's say absolutely. They're in a great spot. The valuation is very low. It's setting up as a potential squeeze candidate. And Corsair Gaming definitely is one of those stocks I think is going to perform very well over the coming years. Never mind the wild card with Corsair Gaming. This is the wild card. One big game comes out. And all of a sudden the space is going crazy again. And also, if we can get GPUs and CPUs to calm down a little bit, that would be very, very bullish for Corsair as well when it comes to building gaming PCs. So yeah, Corsair, nonetheless, I definitely like a lot one, and that's why it's one of these on the list. Let's get in the next one up here, which is Honest Company, HNST. They make diapers, baby wipes. They make beauty products, so makeup products. They make soaps and shampoos, cleaning products, many various products like that. Company has just grown from literally nothing a decade ago to actually a very respectable company. And if you go into Target, you're going to see Honest SKUs all over your Target, which Target's the most well-run retailer out there over the past several years. So when it comes to Honest, about a $600 million market cap, so very, very small market cap. This one's going to several $1 billion over the next few years, in my personal opinion, as based upon where I think their net income's going over the next couple of years. The percent of float short at 14%, so you're kind of in that mid-range. Not a crazy number, but it's also, a decent number. 3 month has been devastated for the stock. It's down 26% in the past 3 months. And like I said, with most of these stocks, the last 3 months have just treated these stocks awful. It's right near its 52-week low right now. 52-week high is 23.88. So yeah, nonetheless, it's down way more than 50% as far as this company goes. $1.65 million of revenue per employee for this company, and that should increase over the coming years. Analysts say buy this dang stock right now. Yeah, I think this one's easy money over the coming years when it comes to HNST. So in terms of 22, they're expected to lose a little bit of money, only 12 cents. Now that's coming off of 40-cent loss expected in 21, so which is a huge rapid improvement. That's something I love to see. And I think this company is going to flirt with profitability in 23. And actually, I think they're going to eke out nice profitable quarters in the back half of 23, especially so. Here's a company that went from taking big losses to small losses to in 23, they start to reach profitability. And when you get the companies that are going to that range, and if all of a sudden you can have a profitable quarter, next thing you know, your stock price turns so dang fast. I've seen it time and time again. When you flip from unprofitable to profitable and you sneak in a quarter of profitability, your stock goes wild because just so many investors and funds get excited about that. Also, if folks couldn't think about investing in you because you were losing money, then all of a sudden when you start making money, a lot of folks can consider you. That was one of the factors that drove Tesla stock as crazy as it did, is it went from a company losing tons of money, like a fortune, to all of a sudden in a matter of a year or two, they stopped losing money and they started to make a little bit of money, and then they've increased their profitability rapidly over the last year or so. And so that's one of the main reasons why Tesla stock has boomed. Now, when it comes to this company, 13% plus revenue growth expected for this company in 22, which is a really healthy rate. I don't know when Honest stops growing, but I don't think it's in this decade. I think they're just going to continue to grow and grow and grow this business model. So yeah, it's one that's in a phenomenal position. It's one I'm personally, if you're talking about one of these stocks that I'm personally investing in heavily right now, I am investing heavily in Honest Company, literally as we speak right now. I put several $100,000 in the stock just over the past month or two. So this is one I'm actively buying. If it continues to go any lower, I'm going to continue to buy this one very, very strongly. So yeah, I hope you guys are enjoying this video. Don't forget to subscribe if you haven't subscribed to this channel yet. If you're looking to apply for my private stock group, the private Discord channels, things like that, check out pinned comment down there. Let's get in the fifth stock of these 10 stocks that are in the stocks to buy down 50% plus. And that one is Oatly, O-T-L-Y. This is a company that's disrupting the dairy industry as we speak right now. And they're in a phenomenal position over the coming years. This one is another one of those stocks that's just been treated awfully. This is the worst stock you're going to find in this list for a 3-month, by the way. But look at, I mean, from 29 to 7, it's a stock that's went public in the past year, which a lot of these companies have in common. They've just been devastated. But look at the 3-month for this one. Down almost 49% in 3 months. That's why I just started buying this one very, very heavily very recently here, because I'm looking at this one, I'm like, this is completely unsustainable in terms of the way this share price is being treated. And if you understand about this Oatly brand, you've done your research, you might realize like the opportunity for this company over the coming years is ridiculous. The sell-through is crazy for them. And they're getting expansion into every single retailer you want to get into, not just in the United States, but outside the United States as well. They got a massive factory they just opened recently in China. And they could end up becoming bigger in China than they are in the States, which is crazy. Because if you're at all educated on the plant-based food space, you know Oatly is like the king of oat milk, essentially. And they have other products outside of that, you know, ice cream products that are made with oats as well and things like that. And they, like the textures, the taste, everything is just insane how out of the ballpark they've knocked it. They're the creme de la creme. That's all I'm going to say. They're the creme de la creme of this space, and they're going to set up to be a ridiculously profitable business model. They got a new factory that just opened in Utah recently. They're going to have to build out a lot more factories over the coming years. That's all I'm going to have to say about that, because the sell-through is crazy, and it's not going to slow down anytime soon. When it comes to Oatly, this is a company that is a slight money loser, mainly just because they're trying to build the business as fast as possible. They're adding as many employees as realistic. They're adding factories. They're building out. They're marketing. They're doing everything they can possibly to do because they got crazy revenue growth for this company. Look at this one. This is about the fastest revenue growth on this entire list. For 22, this company is expected to grow 60% plus. And this is for a company that's expected to do about $1 billion of revenue. So you don't really usually find companies growing at that clip that are you know, you're talking about 10 figures of revenue. This is a company that is another one of those companies that if you buy into, you don't have to worry about this company not growing over the next decade. And believe me, this company is going to be ridiculously profitable. When you're selling these cartons of oat milk for, you know, $3, $4, $5, yeah, there's going to be a lot of money to be made, especially as this business scales and they don't have to market as heavy to get their name out, because right now they're in a market share battle. They want to get as much market share as possible. And so this one is just set up to be a, you know, if you want to talk about a multi-bagger stock opportunity, this is that company that is a multi-bagger type stock opportunity in front of it over the next several years. And so we're at the infancy still of the plant-based food space, and the biggest change, in my opinion, that we've had in the food industry in many, many decades. And this is something that's not slowing down. It's going to continue to pick up steam, and Oatly is in a phenomenal position to thrive in this industry. And so this is one of those, like, you know, if you're not on this wave yet and you haven't really looked into the plant-based food wave, I implore you to look into this and really understand where this industry is trending over the next 10 years, because I think you'll start to really understand how big this opportunity is. It was kind of like, when I was early days on the EV wave in 2018, 2019, not a lot of folks really understood how big this wave was going to be. And now they're starting to see it with every single, here we are in 2022, right? Every single automaker is going EV. Everybody's focused on EVs. Oh, EVs are the future. You got Ford, GM, everybody's doing it, right? And so this is the same exact trend that's going to go on in the plant-based food space, where all the big traditional food companies are going to have to switch. But the problem is, when you are known as being, not a plant-based food company, you have to switch. You have to try to change the way consumers view you, and that's tough. No different than if I think it's even going to be tougher for the traditional, basically food companies to switch to plant-based food companies. I think it's going to be tougher than actually the auto manufacturers, because if you're used to eating a certain product and you associate that with eating that certain product, and then you try to switch to being something else, that's really, really tough, it's incredibly tough for the traditional OEMs to switch over to EVs, right? So this is something to just kind of keep in mind. Look into this industry. That's all I'm going to say about that. Okay, next one up here, number 6 of 10, FUBO, F-U-B-O, FUBO TV. So this one's right around 52-week low, down way over 50%, 52-week. I mean, this one, it's awful. It's at $13. It's at 52-week highs, 57. Look at that, 57 to 13, just awful. Oh no, I thought Oatly had the worst 3-month. No, actually, FUBO has the worst 3-month in this one, down 53% on a 3-month. Oh my word! Oh, 1 year down 59%, and obviously, down way more than 50% on a 52-week range. Oh man. This one pretty heavily shorted, not as crazy as some of these stocks, but yeah, it's shorted pretty heavily. Almost 20% of the float is short. $2 million plus of revenue per employee for this company, market cap of $2 billion on this one. Analysts are obviously pretty bullish on this one. If you don't know about them, they're basically kind of like a YouTube TV competitor. But the thing is with FUBO, or FUBO, whatever you want to pronounce it, the thing that they do really well is they market for sports people specifically. So they understand, we want to get in front of sports people. So folks that like sports, like guys that like sports, right? Or whoever that likes sports, let's get in front of their face and let's become the player. So we're known as that. Okay. And I think it's kind of brilliant on the marketing strategy. Now, it's a money-losing company, so it's another reason why the stock's been pushed down 53% over the past 3 months, because investors just said over the last 3 months, we don't want anything to do with unprofitable companies. And so it doesn't matter what you got going for you, you got thrown out, right? But look at the progress that's been made for this company. They lost $7.40 last year, down to $2.62 and down to $2.29 expected in 22. And don't be surprised if they actually lose less money than that. And it's actually $1 something they lose in 22 per share. Now, 184% revenue growth though in 21 expected. 70% plus revenue growth expected in 22. That's a crazy number. How many companies are really putting up those sorts of numbers? Now, they're spending like crazy on marketing and everything else right now for the company, because this is a huge opportunity. They want to build into a company that's got revenues of, many, many billions of dollars. And the beautiful thing with this business model is, as they get more and more customers using their product, they'll be able to tame back the crazy marketing spend, right? Because then you don't need to market as heavy if you already have a ton of customers, and then you can become much more profitable business model. The other thing with this one, I think it's a potential buyout candidate. I think, YouTube TV might look at potentially buying them out. I think there's traditional satellite companies and cable companies that might look at buying them out. I think potentially even a company, as crazy as it sounds, I think there's even a company like ESPN might be interested in potentially buying them. Those are all, just assumptions I'm making. But regardless, I don't think in order for this one to succeed, I don't think they need to get bought out. When you had this sort of revenue growth, this is another one of those that, like almost every single one of these stocks on this list I put on here, this is one of those companies that over the next decade, you don't have to worry about them not growing. Like, they're just going to continue to beast and grow and grow and grow year after year after year. It's just a question of what rate do they grow out. So yeah, this one over the coming years is a big one in my opinion. So yeah, that one's in a pretty good position. Next one up here of this bunch of these stocks to buy that's down 50% plus is BYND. Beyond Meat, $66. This one's down way over 50% from its 52-week high. 50% down would be what? $110.50 a share, right? $110.50 a share would be down 50%. This one's at $66. It's been treated awfully Wow. You want to talk about the most heavily shorted stock, I think, on this list? 36%. Setting up for a massive potential short squeeze with any type of good news for Beyond Meat. Recently, they just had a deal come out in the past couple of weeks with KFC, which is a big deal for them, getting a lot of publicity around that deal. And the stock, shot up based on that news. And now everybody's kind of waiting on the numbers. I mean, look at that 3 month, down 37% over the 3 month. 1 year, down 52% plus. I literally just started buying back this stock very, very recently. I was out of it for a while. I've kept track of it, but I've seen enough progress with the company now to get me back in. And so I just bought back in very recently here. And nonetheless, BYND is in a pretty good spot. The reason being is they're expected to have revenue growth acceleration. Now, this is a huge deal because what you're going to find in all these companies that are on this list, and pretty much every public company out there, is whatever revenue growth they do in the last year, they usually go down, right? So let's say you do 14%, then it goes down to like 12% or 11% or 9% or something like that. With BYND, there's a special stock that's in a special situation over the next 1 year and over the next several years. And the reason I think this one is set up to be a massive short squeeze is because of this reacceleration. And what I've seen consistently throughout time is companies that have a reacceleration of growth, during that year, their stocks go wild, okay? And so it's not a promise that that's going to happen this year, but I'm just telling you, watch out. That's all I'm going to say about that. Watch out. Now, when it comes to BYND over the long term, it's a company that has a huge opportunity. They're the most famous plant-based food company in the world, right? That's huge. Think about where this company was. I watched there's a great Netflix documentary called Cowspiracy on Netflix, right? And in that documentary, you see actually BYND, Ethan Brown makes a guest appearance toward the back half of the show, toward the end. And it's just funny because the company was like nothing at that time. It was like an experimental type company, right? And to see where this company's at, where they're doing deals with Taco Bell, with KFC, with McDonald's, and you see them in all these retailers now, it's amazing to see how much progress this company's made over the last 7 or 8 years. That Cowspiracy was filmed around 2014, 2015, okay? And so it's nothing short of shocking to see how much progress this company's made. And it is a money-losing company, so that's another reason they've got thrown out. Now, they have a serious competitor in Impossible Foods. However, I think there's plenty for both companies to succeed in their markets over time. And the good thing Beyond Meat has, at least, is they're more famous than Impossible. So, yeah, nonetheless, that one's a pretty crazy one to watch over the next year and over the next several years, all right? Next stock up here of these stocks to buy is Palantir, PLTR. So Palantir is at the cross sections of data and artificial intelligence. They help companies, governments, whatever, make better business decisions at the end of the day, okay? The only downside I see for Palantir, and the only downside I really see for this company, is honestly a little bit around short-term valuation and a little bit around, I think, some bad press that's been coming their way but could come their way even more if they have more success as a company. So right around its 52-week low very recently here, down way over 50% over the past 52 weeks for this company. 45 was its high. Not a heavily shorted stock. About 6.4% of the float is shorted on this one. Market cap of $30-something billion very recently here. Devastated past 3 months. 33% down the last 3 months. Oh my gosh, okay? So Palantir has been treated badly. Now, when it comes to Palantir, profitable company. Expected to do 20 cents of profits in 22, which isn't a huge number, but it's still profitability nonetheless. The way I view this company is as it scales, it's going to become a profit machine, a cash flow machine. And the reason being is I think their business model is going to be very, very sticky. I don't think they're going to have to market very heavily starting in a couple years from now. And I think most companies, especially that are big corporations, are just going to use them. And I think they're going to have pricing power as well because it's going to be such a sticky business model. It's going to be hard to leave Palantir. And when it comes to this company, another one of those, if you want to talk about a company you don't have to worry about not growing this decade, it's Palantir. I don't know when Palantir stops growing, but I don't think it's in this decade. Based upon the growth rates I expect for this company, they're just going to continue to grow and grow and grow. And it's just a question of how many years can they keep up a 30%-ish growth rate versus a 20% versus a 10%. But nonetheless, the revenue growth opportunity is crazy for this company, and they're going to build into a cash flow machine. They're going to basically, they're going to be a money printer. That's all I'm going to say about this. So, yeah, Palantir had to make this list as far as these stocks to buy, okay? Number 9 up here of these stocks is the Planet. Planet 13, PLNHF. Okay, Jack Jackson play here. If you don't know Jack Jackson, you're not up on my videos. Okay, $600-something million market cap, down way more than 50% from its 52-week high of 867 for the stock. 3 month down 21%, 1 year down 42%. When it comes to the Planet, they have their massive retail stores. They have one here in Vegas, which, if you ever come to Vegas, even if you're not into the product they sell, go check out the store because it's absolutely incredible. They have a massive superstore now in Orange County. So if you're ever in Orange County area of California, check out that superstore. They got a store coming likely in Chicago this year. And they also have stores likely coming in Florida this year as well. And they own a ton of brands that are super, super popular and have tons of market share out there in the markets they compete with, okay? And their management team has their heads on straight. They're in a great capital position for this company. It's ridiculous, okay? Also, a company that's profitable. And here's the thing with Planet. This went from a money-losing company, you look what they lost last year, and you look what they lost a year before, was a ton of money, to all of a sudden now they've switched to, small loss, small loss, and now they're expected to potentially eke out a small gain here at the end of 21, and then they're expected to increase profits rapidly in 22. I think that's another reason why Planet sets up as a stock that could be a huge winner, not just over the next 5 years, but over the next 1 year, because when you can go from this to this, that's a huge difference. Also, another one of those companies, this is not one that I can see not growing revenues over the next decade. Like, they're just going to continue to grow at a rapid clip as they open more and more stores. Those stores become more and more popular because a lot of times it takes 1 to 2 years for them to ramp a store in terms of getting its popularity up, right? As they become a more and more famous known brand around the United States, that's going to bode very well for this company over the coming years. And this is one of those stocks that I look at as just a crazy profit potential and revenue potential over the coming years with the management team that has them on the right trajectory to become a giant in this industry that they compete in. And so this is one of those stocks I look at that's likely going to be a multi-bagger stock in terms of one of those stocks that could be a 10x plus type stock over the coming years. Federal legalization is whenever that does come, which we will go to federal legalization in the United States over the coming years. Whenever that baby does come, oh my gosh, is it going to be huge for this entire industry and for this company? Because then all of a sudden they can start shipping over state lines. You don't have to have production facilities in every single state and things like that. Like, oh my gosh, like what that will do to the revenue and the profitability of this company is going to be crazy. And what that's going to do for the excitement for this industry. And if you've been tracking this industry over the last 5 years, you're going to see that everything is lining up exactly how you need it to be for federal legalization to come. Everything's just going according to plan, and this one's, in my opinion, is going to be a giant in this industry. So yeah, this will only be an under the radar stock for so long. And 5 years from now, this will be one of those stocks that's viewed as a giant in their industry, and will be one of the first stocks that people think about if they want to invest in this industry and capitalize on what will be going on in this industry over the next decades. Let's just call it that. It'll be one of the first stocks people think about, okay? That's a Planet there. I'm a huge investor in that one, believe massively in that one over the next 10 years, okay? Next one up here, well, this one couldn't make the list, okay? Because I had to address this because I know people would ask, like, why didn't TTCF make the list? It couldn't make the list because technically it's not down 50% plus from its 52-week high. So, yeah, that's why that one couldn't make it. If it was down just exactly 50%, it would have been able to make the list, but it couldn't make the list. And this is that one that they're expanding across the United States, getting more and more SKUs in stores and things like that, plant-based food player. So, yeah, they couldn't make it, okay? 10 stock up here is Sam. So this one's near its 52-week low. Look at the 52-week high on this one, $1,349. Is down 50% on the 1 year. Obviously down massively more than 50% over the last 52 weeks, right? As far as the 1 month, down 15%. Down 13% over a 5-day. Not a heavily shorted stock. About 7% of the float is shorted on this one. They make Sam Adams, if you haven't heard of that. Oktoberfest. They own a lot of different brands. I don't want to go through all the different brands. And they own the Truly brand, which is big in the hard seltzer category. They're expected to get profitability back in a major way in 22. I mean, yeah, nonetheless, this is why this stock fell from $1,300 plus to $400 because their profitability went through the floor. They got way too bullish on the hard seltzer category. They had to waste a lot of product. It cost them a fortune. And nonetheless, they got it wrong in 21. That's flat out honest truth. They got it wrong and they're expected to get back on the right track in 22. The management team, they screwed it up this year, but they got a phenomenal track record. Like look at how far this company's come over the past decade. they've done nothing but an extraordinary job running this business and growing brands just phenomenally, okay? It's just they got it wrong in 21, but they're expected to get back on the right track in 22 and get revenues in the back, back to 10% plus. And they should be able to grow, in my opinion, anywhere between 5% and 12% revenue growth over the next, basically, 5-10 years or so. And so I think that one's set up in a good place. Not the highest growth company, actually one of the lower growth companies on this list, but one of the safer companies in terms of what they've proven over their business model over time versus where they're at. Okay. Hope you guys enjoyed this video. As always, if you haven't got to download the Hungry Bowl yet, that is my app along with some other huge creators out there. Basically a way to track your stocks, what's going on in the market. One of the biggest features outside of, being able to track your stocks and things like that is listen to earnings calls. We're about to go into massive earnings season right now and be able to listen to all your earnings calls. Simply, you click on the tab, you listen to whatever earnings call you want to listen to for whatever companies. And also we backlog them. So if you want to listen to several past earnings calls of companies, you can do that right inside the app and it's absolutely free. We literally make it free so you guys can use it for free. And folks that love it, really love it. Thank you to everybody that ever leaves us a positive review. We appreciate you guys. Much love as always. Don't forget, if you want to subscribe to the channel, it's absolutely free to do. If you want to apply to join my private stock group, the private Discord chat, everything like that, check out pinned comment. Much love and have a great day.